Hello and welcome back. We will in this section, in this lecture of the in this part of the lecture, we will be looking at more details of the balance sheet, or sorry, more details of the assets which we promised earlier. So here you can see we have assets here. So in the previous section we said that we can see the details of property, plant, equipments, capital, work in progress, intangible assets in schedule 1. So let's look at the schedule 1. What does it say here? So here the property, plant and equipments. In this schedule you will be seeing that there are okay, now I think it's okay. There are 3 blocks: gross block, depreciation, and this is called net book value. So what is it? The gross block means whatever we paid to buy these assets are gross block. It is also divided into many sections. Means as of beginning of the financial year, how much was the value, how much we add more to our gross block, means how much did we add more, buy more assets, how many assets did we dispose or adjusted, maybe because they are completely disposed, or maybe they are revalued, or their value is less. So what is the gross block at the end of the financial year? For the purpose of financial reporting, we normally look at the net book value. Now the depreciation and amortization, in the beginning of the year we had depreciation of such value $104,000. Now lease assets, for example, here leased assets are not are depreciated based on the period when how much their annual period is, so that how many years of the lease they have, so that we know how much is the period left here. They are not, they have completely ships are completely written off. Now let's look at this first. Leasehold land. So they have 19,000. Okay, we consider it as 19,000. Forget about crore rupees. $19,000. Then they have accumulated depreciation of $915. Now you see they are depreciating 195, which is 10%, which is 1% of this leasehold land. It means that this company hold this leasehold land for 100 years. That is the reason why they are depreciating at for 1% for every year. So they are slowly depreciating. So now you can actually arrive at how much value, how many years ago they have bought actually this set. This is look like about 9 years or 8 years. Sorry, 5 years. Yeah, 5 years, around 5 years. So 5 years they 5 years ago they acquired leasehold land. Now they are depreciating it every year 1%. The net block is $18,000. Now what is the value of this? Is the historical cost. They must have paid a premium of $19,000 to buy this land. Is it the real value now? The balance sheet is never telling what are the current market price, unless the accounting unless the preparer of financial statements have revalued the assets to their market value, which is also permissible in the financial reporting standards, but then you have to do it every year. Most of the companies, they don't do that because they don't want to, it's a costly exercise. Freehold land. So freehold land has no depreciation because you hold it forever, and normally land never depreciate its value, unlike leasehold land where you paid this money for 100-year use, and you are using, and every year you are charging off 1% of whatever you paid over a period of 100 years, because after that it will expire, right? Buildings. These are all the buildings, or the improvement of buildings, or the physical part of the buildings are here. 12,000 was initially, then they bought another $2,000, they added more, total becomes 14,000. They have been charging $4,800 in the past. This year they charge $512. Now it depends on the life of the building itself. There are no more details about these, how this depreciation is calculated in the financial statements, but you can look at the assumptions. We can look at the assumptions of the financial reportings. So let's look at it now. Here we can see in after the here in the notes of accounts, companies are usually here you can see the corporate information, then there are significant accounting practices, and there are significant accounting policies. Here you will see the policies, how they are charging the depreciation. So property, plant and equipments are stated at cost, net of recoverable values. The depreciation is charged where the depreciation on property is using written down value method. In case of certain assets, the life, normally they are mentioning the life as well, which is not mentioned here. Lease, intangible assets, yeah, they are not mentioning the life. Yeah, here computer, others. In case of Jetty research and development, no, they are not mentioning the life, how many life they are using it. So that one, if you want to know more details, we probably have to go to the company and ask. And you can ask, if you are a shareholder, you can definitely ask how much life has been calculated for these gross block. Now we're going back to the financial statements. I mean, these are one of the drawback of reading the financial statements. They don't give all the information, and sometimes the information which is given is misleading. They are not complete. For example, here now they have plant and machinery, they have electrical installations, they have equipments, furniture, vehicles, ships, aircrafts. Then this is also they have some lease assets. Then now they have some intangible assets. So let's look at the intangible assets. What kind of intangible assets this company has? Here they have technical know-how fees, means they have acquired technical know-how from other companies to run their plants and machinery. So they paid $3,000 in the beginning, $800 now, so it's become $4,400, and now they are amortizing it based on the number of life or how many years they have acquired the fees for. They have softwares, they have development rights, they have other fixed assets. Probably other intangible assets are most likely the patent rights and other things, to the cost to acquire. Now they have other capital work in progress, means there is no more detail about the capital work in progress, no more details about the intangible assets under development. So this is one of the gray area in financial statements. You cannot get whole details, but if you are a shareholder, you can definitely go and ask, and if it's a listed company, they are obliged to answer your queries. What are the pitfalls and why these are necessary to know? We will look at it in the next section. So now let's look at the other items. So we have looked so far on the property and on these assets. Now financial assets, let's say investments. Now investments is in number 2, right? So we go to number 2 and then we see investments, non-current. So how they have put the money in, this is how they have put the money in. Now they have invested at in preference shares of associate companies. This is their own company. In government securities, some money here, 3,500 nil. And then they have some other investments here. The most of the investments is in their own Reliance Jio Infocomm, which is their own subsidiary company. So the most of the investments which is coming from their investment part is their own companies. They are not investing in other companies, or they have bought the preference shares from others. Loans, non-current loans, they have given loans and advances to related parties. Here this is very, very important to focus on. The loans are given to related parties, deposit related parties, loans to related parties, other loans and advances. It's only a very fractional amount, but the most part of it is going to their own related parties. You can see the details of related parties in another note. Why the companies are doing this? I mean, they are doing the businesses, right? So they loan to their own companies. They are not going to give you the details of who are those companies. They are giving you the details of who are those companies here. $18,000. No, this is different. Sorry. And then there are more details about the more here. You can see in the note 31, but that's not in this one. Loans and advances in the nature of loans to be given to subsidiaries. So these are the different type of loans they have given. $16,000. Sorry, we are moving, my mistake, too fast. Here $16,002. Here is $16,002. So they have given the loan to Reliance Industries Investment and Holdings, Reliance Corporate IT Park. So this is how their loans are given to their own internal parties. This is why we need to go into the details. If you look at the face of the balance sheet, you don't know this one is going to their own parties or this one is going to individual parties. You need to look at the details of the investments. Now look at the non-current assets. This is number 4. Sorry, we skipped that. Number 4 here. So number 3, then you have number 4. Other non-current assets are capital advances, advance income tax, which is normal in the companies where they give advance income tax to government, which is required by the law. And then here you can see capital advances also. They may have paid some money for buying assets in advance. You will see a little bit of asterisk here. The auditors have put the comments here. Out of 312 crores, 295 are related to the gas pool account deposit, which was paid. So which is normal as a business activity, which is normal. Now advance income tax also is broken down into the different more details on how much was it at the beginning of the year, how much taxes they paid this year, and then they paid more money for this year. So the net balance is how much. So this is how we need to see the details of the balance sheet. Now we look into the current assets here. So the current assets are inventories. Inventories also have valuation. So if you want to know how the inventories are valued, so where will you go to see the value? So here we will go again. We will look into their notes of accounts, and then we will see here, okay, the inventories are measured at lower of cost or net realizable value, or after providing the value for obsolete stock. So this is the way how they are describing how they have valued the assets. So normally if they written down the value based on net realizable value, they normally explain in the details, but let's see if they have done it here. Inventories, here you can see they have broken down the inventories into raw material, work in progress, finished goods, stock in trade, stores and spares. So there is no mention about writing down the value at the net realizable value, so one has to assume this is all at cost. So we look at other assets now. These are current investments. So here you can see these are the current investments, also in various government bonds, treasury bonds, for utilizing the cash while it's lying in the bank. Instead of that, they are putting it into the bonds or mutual funds so that they can earn some interest or some dividend for the company, maximizing the value. Category wise, so this is one of the disclosure by the stock exchange, which category they are using the investments, so they have to explain it. Trade receivables are the receivables for which you are doing a business, so sometimes you have to sell the goods in credit. So that are the value. These trade receivables are the value which you are supposed to receive from the supplier, from your customers. Normally if there is unrealizable debt, the auditors would point it out that if this audited, normally they are supposed to disclose how many of them is more than 120 days or 300 days, so that the user of the financial statements know what are the risks involved in collectivity of these trade receivables. We will be looking at it in more details in the coming video, because now the maximum limit is off.